In making investment or financing decision, we have said that cash flows should be used, but plotting these cash flows requires an understanding of certain concepts. So, in this and the following two presentations, I'm going to lay out the key concepts in plotting cash flows for making investment and financing decisions. Now, profits and cash flows are not the same. So, in finance, all decisions, be they investment or financing, are based on cash flows, they're not based on profits. Profit is based on revenues and expenses, cash flow is based on collection and payments. Now, what this implies is that not all revenue is collected immediately, and all of you would know that, and not all expenses are paid for immediately. Cash flows can be of three different kinds. One is cash flow from operations, the second is cash flow from investment, and the third is cash from financing. Now, in each of these categories, you could have both inflows or outflows. For example, investment cash flows are those related to buying and selling of long term assets. For example, if a company bought a building, it would have an investment cash outflow, but if it sold a building, it would have an investment cash inflow. Likewise, if a company borrowed money from a bank, it would have financing cash inflows, but if it repaid that loan, it would have financing cash outflows. Operational cash flows are usually the payments to suppliers and collections from customers, and payments and collections related to day operations, such as payment of salaries and so on. So, when we make investment decisions, we should consider operating and investment cash flows. In making financing decisions, we should consider the financing cash flows. So, all cash flows, whether you're making an investment decision or financing decision, should be considered after taxes. Here we are referring to taxes on income or taxes on profit. Most organizations prepare financial statements such as balance sheet, income statement, and cash flow statement routinely, and profit is a number that is available in most organizations easily. But converting these profits into cash flows requires certain adjustments to be made. So, when we start with profits and we want to convert that into cash flows, especially operating cash flows for making investment decisions, there are two main adjustments to be made. One is adjustment for depreciation, amortization, and other non cash expenses. These must be added back to the profit in order to arrive at the operating cash flow. Why is that? Because depreciation, amortization do not involve any cash flows. Neither do we receive any money, nor do we pay anybody when we depreciate or amortize a long term asset. The second adjustment that needs to be made in order to convert profits to operating cash flow is the adjustment for working capital. Now, there are many items that go into working capital, but the three important ones that we need to consider are the accounts receivable, that means money due from customers, inventories, that means goods that are kept as raw materials or finished products in our warehouses, and accounts payable, which is money due to suppliers. So, to put it simply, working capital can be thought of as account receivable plus inventories minus the account payables. So, what is the big picture? In order to make investment and financing decisions, please consider cash flows and not profits. If you have profits, these must be converted to cash flows, and in doing this, you must make two adjustments, namely one for depreciation and the other for working capital.